right now, if you just, take your phone out of your pocket, you can record this massive high-definition 4K video of your dog,
Oh, sure.
and you can beam it to a friend in Tokyo in, what, about 2 seconds?
Yeah, practically instantly.
Right, and it's totally free over the internet. The data just flows effortlessly across the globe. So why is it that if you want to send a $100 bill to that exact same person, it takes 3 business days?
And costs a fortune.
Exactly. It costs like $15 in wire fees, you get hit with exchange rate margins, and you have to fill out this stack of digital customs forms.
That's wild when you actually think about it.
It really is. I mean,
Yeah.
we live in this era of instantaneous global communication,
Mm.
yet our money still moves like it's being carried on a digital stagecoach. So today, we are diving into our source material to completely dismantle the illusion of modern money.
It's a really powerful illusion, right? Because we all just treat our current financial system as if it's this fixed, immutable law of physics.
Like gravity or something.
Exactly, like gravity.
Mm.
We assume money has always been exactly what it is right now. But the fundamental reality, and this completely shifts how you view the world when you grasp it, is that money is and always has been a highly mutable technology.
Right.
The way we define it, how we move it, how we trust it, it's been in this constant state of transformation. And every single time the definition of money shifts, it just ripples out.
It changes everything.
It does. It fundamentally alters trade, power dynamics, individual opportunity, and just the very shape of your daily life.
Which brings us to our stack of source material today. We are doing a deep dive into this incredibly comprehensive document titled The Evolution of Money, from Barter to Programmable Value.
It's a fantastic text.
It really is. And our mission for this deep dive is to offer some serious grounding clarity. If you are someone who wants to understand the world of crypto, blockchain, digital assets, but you want to do it without the anxiety.
And without the blind financial hype.
Yes, please. Entirely removed from that chaotic internet culture noise. If that's you, this is exactly where you have to start. You have to first realize that crypto didn't just drop out of the sky like some alien technology trying to burn down the financial world.
Right. It's not an isolated event.
No, it is simply the latest chapter in a massive ongoing historical story of human problem solving.
And context is everything here. I mean, when you place these new technologies inside that larger historical journey of how human beings coordinate value, the confusion really does start to dissipate.
It starts making sense.
Exactly. You begin to see this not as some high-risk trend, but as a totally logical engineering response to the very frictions you just mentioned with your Tokyo example.
The digital stagecoach.
Right. So today we are going to unpack the mechanics of that journey.
Right.
We'll look at how we move from, trading physical grain to the invention of ledgers to the digital interfaces on your smartphone.
And finally to that new frontier of programmable internet native value.
Yes. Because by understanding the how and the why of this sequence, the whole future of the global economy starts to make a lot more sense.
Okay, let's unpack this. To really understand the friction in our modern system, we have to kind of go back and establish what money was actually designed to do in the first place.
Back to the beginning.
Right. The source material starts us in the pre-money era, the era of pure barter. And a lot of us have this, this really simplified textbook idea of barter.
The whole I have wheat, you have shoes.
Exactly. A farmer gives a blacksmith some wheat, and the blacksmith repairs the farmer's plow. It sounds idyllic. It's this direct physical exchange of value in a small, tight-knit community where everyone just knows each other.
Well, it sounds idyllic until you actually try to scale it up.
Right.
The fundamental limitation of the barter system is this concept economists call the coincidence of wants. For a transaction to occur, it is not enough that you just have a surplus of goods.
You can't just be rich in apples.
No, you have to find someone who has exactly what you want and who simultaneously wants exactly what you have.
At the exact same time.
Yes, at the exact same time.
The way I always like to visualize this friction, because I think it makes it so relatable, is to imagine the barter system like a dating app.
Well, that's a good analogy.
But it's an incredibly frustrating one with absolutely no search filters and no algorithms. You can't just swipe to find a match.
Right.
You have to miraculously wander into the village square and find a tool maker who, at that exact second, happens to be hungry for the exact type of grain you have sitting in your cart.
And if the toolmaker wants shoes instead of grain, the whole local economy basically grinds to a halt.
We can't do business. We're stuck.
And that coincidence of wants becomes exponentially harder to satisfy the moment a society grows beyond, say, a few dozen families. But the friction goes much deeper than just finding a trading partner.
How so?
Well, think about how you consistently measure value. I mean, how many baskets of apples actually equal a bronze sword?
It's completely subjective.
Entirely subjective. And furthermore, consider the problem of storing wealth over time. If your life savings are tied up as a surplus crop of tomatoes, your wealth is literally rotting by the day.
Right. You're on a ticking clock.
You are. You cannot store that value for the winter. And you certainly cannot, transport a herd of sheep across a mountain range just to trade with a neighboring society.
So the system was fundamentally anti-scale. I mean, you can't build a global civilization. You can't even really build a functioning city on a system where you're constantly trying to match up random, rotting surplus goods.
No, you can't.
And this leads to this massive aha moment from the text. The realization that money was not invented because human beings suddenly desired a shiny, abstract concept.
Right, it wasn't about the aesthetics of gold.
Exactly. It was born strictly out of necessity. The text calls it a technology of trust and coordination.
A technology of trust. That is just the perfect way to frame it. Humanity desperately needed a tool to decouple the act of selling from the act of buying.
To break that coincidence of wants.
Precisely. They needed something widely accepted, easy to compare, and highly durable. And this pushed societies to invent physical money. So, shells, beads, and eventually the really big breakthrough standardized metals and coins.
Because the standardized coin acted as a universal bridge.
Yes. You could sell your harvest for silver in the autumn, store that silver safely without it spoiling.
Because silver doesn't rot like tomatoes?
Exactly. And then use it in the spring to buy tools from someone who had absolutely no interest in your original autumn harvest.
But the sources bring up this fascinating historical nuance right here. We always assume the value was intrinsically in the shiny metal itself.
Right, the inherent value argument.
Yeah, but if we look at historical examples from the text, like the rice stones on the island of Yap, the concept of money was actually much closer to a ledger from the very beginning.
Oh, the rice stones are such a perfect example.
They're amazing. For those who don't know, these were massive, immovable limestone discs. Some of them weighed like 4 tons. When people traded them, they obviously didn't physically roll a 4-ton rock across the island to pay for a pig.
That would be a nightmare.
Right. So they just verbally agreed that the ownership had transferred. The money wasn't really the rock. It was the collective memory, the shared ledger of who owned what.
And that is a crucial insight for where we are heading later in this discussion. The physical coin, or the giant stone, was really just a physical manifestation of a social consensus.
The shared illusion.
Exactly, a shared illusion we all agreed to believe in so that we could coordinate. But even with standardized coins, physical money introduces its own profound physical limitation.
Right. Let's explore that limitation. Because say I am a really successful merchant in the 14th century, and I want to make a massive trade. I want to buy an entire fleet of ships in Venice.
Yeah.
But all my wealth is stored in London. Carrying literal heavy wooden chests full of gold and silver coins all the way across Europe is a logistical nightmare.
Oh, it's incredibly dangerous.
You have to hire armies of armed guards just to fight off bandits, and it takes months of travel. The physical weight and the danger of the money becomes the very friction that starts holding international commerce back.
And physical limitations always force evolutionary leaps. The sheer danger and inefficiency of moving massive quantities of metal paved the way for the era of banking.
Right, the next chapter.
And we really need to look closely at how this transition occurred, because it didn't just add vaults. It fundamentally changed the very definition of what money actually is.
How so?
We moved from money being a physical object you hold in your hand to money being an institutional promise recorded on a ledger.
I want to dig into the mechanics of that shift, because it wasn't just, building a fortified stone room. If we look at the rise of the Medici Bank in Renaissance Italy.
Oh, the Medici were pioneers here.
They were. They didn't just hoard gold. They revolutionized double-entry bookkeeping. They created a system where you could deposit your heavy gold in a vault in Florence, and the bank would just give you a piece of paper, a letter of credit.
And that piece of paper quite literally changed the world. Suddenly, you didn't need to transport the chest of gold all the way to Venice.
Yeah.
You just traveled light with a letter of credit, presented it to a branch or an allied merchant in Venice, and they would honor it.
But the real magic happened in the ledgers, right?
Absolutely. Because if you owed me money, and we both use the same banking network, no physical gold actually had to move at all.
Which is wild for that time period.
Right. The bank's clerk simply dipped a quill in ink, subtracted a number from your column, and added a number to my column.
The ledger literally became the money. The lifeblood of economic activity shifted from handing over physical objects to just updating records inside centralized, trusted institutions. And if you think about it, this is the financial water that you and I swim in every single day. You get a job, you open a bank account, your employer's bank sends a digital message to your bank, and numbers just magically appear on your screen.
You never see a physical dollar.
Never. You just trust that the institution will honor those numbers when you swipe your debit card to buy groceries. This system of institutional promises is the absolute foundation of the modern world.
And it brought enormous benefits. I mean, it allowed for complex credit systems where banks could lend out more money than they physically held in the vault.
Which basically funded the Industrial Revolution.
Exactly. It created a highly structured environment for trust and regulation. But as with every single stage of technological evolution we're looking at today, solving one set of problems inevitably creates a new set of problems.
Right, the pendulum swings.
It does.
Yeah.
The banking era solved the physical danger of moving gold, but it introduced a brand new friction: centralized gatekeepers.
Let me actually push back on that term a bit, gatekeepers, because I feel like it often gets thrown around as a purely negative thing, especially in tech circles.
That's a fair point.
Our source text actively acknowledges that this friction was largely introduced by design. It's not just that banks are incredibly slow because they are lazy. The slowness is often a feature of the legal and compliance frameworks built around them to keep us safe.
That is a vital point of fairness, and the text is clear on this. The traditional banking system is heavily regulated for a very good reason. We have anti-money laundering laws, or AML, and Know Your Customer, or KYC, requirements.
Right, you have to prove who you are.
Exactly. When money moves across borders, or even just in really large quantities domestically, institutions are legally obligated to check those transactions against international sanctions lists.
They have to make sure the funds aren't financing terrorism.
Right, and they provide mechanisms to reverse fraudulent transactions. That kind of heavy security requires human oversight, it requires administrative checkpoints, and it requires deliberately introduced friction.
But the undeniable trade-off of all that security is exclusivity and inefficiency. I mean, if you are a person who lives outside the physical reach of these banking networks.
Or if you just lack the specific government documentation required to pass those KYC checks.
Exactly. If you don't have the right papers, you are completely excluded from the global economy. You are what they call unbanked. You can't safely store wealth, and you certainly can't easily access credit.
That's a huge barrier.
And even for those of us who are comfortably inside the system, the administrative overhead of constantly reconciling these different private ledgers between different institutions is exactly what causes my transfer to Tokyo to take 3 whole days.
Precisely. As the world became more and more globally connected, the underlying architecture of human clerks, even digital clerks reconciling different ledgers, became a massive bottleneck.
So what did we do?
Well, rather than throwing out the banks entirely, society's first instinct was to just paint a brand new technological layer over the existing institutions. And this brings us to the era of digital payments.
Okay, so we transition from handing physical paper to a bank teller to logging on to online banking portals on our computers to plastic credit card networks and eventually to the mobile apps we use on our smartphones today.
Right.
Money essentially stopped moving through our hands and started moving entirely through our screens. But the text makes a really critical distinction here that we have to explain clearly. This digitization was only on the surface.
Yes. It digitized the interface,
Yeah.
but it absolutely did not change the underlying plumbing.
Right.
When you use Venmo or Apple Pay, it feels like magic. It feels instant. But behind that sleek user interface on your phone, the deep structure, the central bank reserves, the clearinghouses, the correspondent banking relationships,
It's all the same old stuff.
it is essentially operating on the exact same logic as the Medici ledgers from the 15th century. It's still just private institutions sending messages to other private institutions, asking them to update their proprietary databases.
It's totally an illusion of speed. The app on your phone updates instantly to show a lower balance, but the actual settlement of the funds between the two banks behind the scenes might still take days to fully clear through the central banking system.
Exactly.
However, we really cannot underestimate how deeply that surface-level change altered human behavior and societal trust. Even if the plumbing is old, the interface changed the world. And the source material highlights a massive real-world case study to prove this.
India.
Yes, the rapid adoption of mobile payments in India.
The transformation in India over the last decade is arguably one of the most significant financial behavioral shifts in modern history.
It's staggering.
We aren't talking about, early adopter tech elites in Silicon Valley playing with a new app. We're talking about a societal level change involving hundreds of millions of people.
Right.
A decade ago, India was a heavily cash-dependent society. Today, a massive volume of daily commerce, from huge corporate purchases all the way down to just buying a cup of chai from a local street vendor.
It all happens via quick QR code scans.
Yes, linked to a system called UPI, or Unified Payments Interface.
What really fascinates me about the India example from the text is the psychology behind that social trust leap.
It's incredible.
If you walk up to a street vendor in Mumbai today, they don't need to understand the underlying API architecture of how a QR code securely communicates with a central banking server.
They don't care about the code.
They don't need to know the code at all. They just need to know that when the customer scans the code, a little green check mark appears. Maybe a small audio speaker on their cart announces that the payment was received.
And the money is reliably in their account.
Exactly. It proves that our financial habits are highly mutable. Social trust in a brand new system grows exponentially the moment people experience true, reliable convenience.
That vendor trusts the digital notification on their phone just as much, if not more, than they used to trust the authenticity of a physical paper rupee.
It's a complete paradigm shift.
And the text uses this to demonstrate a really vital point. Money evolves through practical adoption. People will embrace a completely new form of value transfer if it simply solves a real friction in their daily lives.
So if we've digitized the surface, and frankly, my local payment apps work flawlessly for me, if I'm at dinner with friends here in the States, splitting the bill takes 2 seconds.
It's seamless.
If my phone already feels like magic, what exactly is the wall we're hitting? Why reinvent the wheel again? Why does society even need another chapter beyond our current digital wallets?
To understand the wall, we have to go right back to your opening example about the 4K video versus the $100 bill.
The Kokio problem.
Yes. Current digital payment systems are brilliant, but they operate within very strict, hidden geographic and institutional boundaries. They are incredibly efficient domestically because you are operating within a single, unified national banking jurisdiction.
So when I send money to a friend at dinner, it's easy.
Very easy. Your bank and your friend's bank likely both hold accounts at the exact same central national bank. The ledger update is straightforward.
But the moment I try to send that exact same money to Tokyo, I step completely outside that sandbox.
And that is exactly where you hit the antiquated plumbing.
Yeah.
Let's actually trace the mechanics of a cross-border transaction today just to show how absurd it is.
Let's do it.
When you initiate that transfer to Tokyo, your local bank doesn't have a direct relationship with your friend's local bank in Japan. They just don't share a ledger.
Right.
So your bank has to send a digital message, usually through a messaging network called SWIFT, to a larger intermediary bank, which is known as a correspondent bank.
Basically a digital middleman.
Exactly. And that correspondent bank has to receive the message, verify it, take a fee for their trouble, and then send another message to an international clearing network.
Oh, wow.
Which then sends another message to a correspondent bank in Japan, which takes yet another fee, and finally passes a message down to your friend's local bank to actually credit their account.
It's literally a game of telephone.
It is. And at every single hop in this chain, different national regulations apply, different currency exchange rates are calculated and skimmed, and human compliance teams may literally need to review the transaction.
Not to mention, these banks operate on traditional business hours.
Right.
If you initiate this transfer on a Friday evening, the digital message literally sits in a queue until Monday morning because the bank's servers, or at least the humans overseeing them, take the weekend off.
The internet doesn't take the weekend off, but your money does.
It is literally an internet interface running on top of a 1970s postal service mentality. The money isn't flowing natively like the data of my dog's video. It's being handed off piece by piece through a chain of digital bureaucrats.
And the source text defines this specifically as the internet native problem.
The internet native problem.
Yes, the old payment rails were designed as closed, walled gardens. They were never, ever designed to act like flexible, open, globally interoperable software.
But the internet itself is exactly that.
Right? The internet is an open, borderless, 24/7 environment. So we have this fundamental mismatch between the communication layer of humanity, which is instant and global, and the value transfer layer of humanity, which is slow, fragmented, and tied heavily to geography.
Which finally brings us to the breakthrough, the next evolutionary layer. When we finally introduce crypto and blockchain into this deep dive, we have to completely reframe it based on the friction we just spent, 20 minutes discussing.
You really do.
Because crypto is not just some arbitrary internet casino, it is an organic engineering attempt to make money fit the realities of a software-driven, globally connected society.
Yes.
It is trying to build a payment rail that actually behaves like the internet.
And to really grasp how it does this, we need to demystify the actual mechanics behind two massive concepts from the text.
Let's break them down.
The first is internet native value, and the second is programmable value. Let's start with internet native value. We just established that the numbers on your banking app don't actually exist on your phone, right? They are just a display of a database located on a bank's private server.
Right, the institutional promise.
Exactly. Well, internet native value flips that entirely.
Right, but how, if there isn't a central bank holding the master ledger, how do we know who owns what? How do we prevent someone from just, copy-pasting their digital money exactly like they copy-paste a Word document?
The famous double spend problem.
Yeah, the double spend problem. How does it solve that without a bank?
That is the core genius of distributed ledger technology, or blockchain. Instead of relying on one single CEO or one central bank to update a private secret ledger, the ledger is public and distributed across thousands of independent computers around the world.
Okay.
Imagine a massive room with 10,000 independent accountants.
10,000 accounts. Got it.
When you want to send internet native value to someone, you stand up in this room and announce the transaction to everyone. All 10,000 accountants simultaneously check their own personal copy of the ledger to ensure you actually have the funds you were trying to send.
And because they use cryptography, these really complex mathematical puzzles, to verify the transaction, they all have to reach a consensus.
Yes.
So if 9,999 accountants say the math checks out, the transaction is permanently etched into the ledger.
Exactly. You don't need a correspondent bank in the middle to act as the trusted middleman because the mathematical consensus of the network is the trust.
The math is the trust.
Yes. The cryptographic token, the digital asset itself, becomes a bearer asset. It exists entirely within the digital network. And because it doesn't rely on a walled garden database, it can flow through the internet just as freely and continuously as an email.
It works on weekends.
It works on weekends. It ignores national borders. It is natively digital.
But I want to pause here. I want to be completely impartial because our sources do point out the immense risks involved in this new architecture. By completely removing the central intermediary, you are also removing the central safety net.
You absolutely are.
In the traditional banking system, if I accidentally type in the wrong account number and send my rent money to a total stranger, I can just call my bank. I can say, hey, I messed up. They can flag it as an error, reverse the ledger, and make me whole.
And that is the double-edged sword of total decentralization. With an internet-native blockchain network, transactions are typically immutable.
Meaning they cannot be reversed.
Never. If you send your digital assets to the wrong cryptographic address, or if you lose the private keys, basically the passwords, that control your wallet, there is absolutely no customer service hotline to call.
The money is just gone.
The money is effectively gone forever. And furthermore, while the underlying blockchains themselves are highly secure, the surrounding ecosystem, like the digital exchanges and third-party wallets, have been subject to massive hacks and fraud.
Right, we've all seen the headlines.
And they generally lack the protections of FDIC insurance that traditional bank deposits enjoy. So it's a profound trade-off.
You gain borderless autonomy and incredible speed, but you take on absolute, unforgiving personal responsibility for your assets.
That's the deal.
Now, let's move to the second major concept, which might honestly be even more transformative: programmable value.
This is where it gets really sci-fi.
It really does. But when I first hear programmable money, my mind immediately goes straight to my bank's autopay feature.
Here.
I program my bank to pay my electricity bill on the first of every month. So how is this new concept any different than that? What am I missing here?
The reason traditional autopay isn't true programmable money is because autopay is really just a scheduled message.
Like an alarm clock.
Exactly. It's a calendar reminder telling a human-built system to initiate the exact same clunky multi-step ledger update we discussed earlier. The money itself isn't smart. The calendar is just sending a prompt.
Okay, so what is true programmable value then?
True programmable value means the money itself acts like software. It is a smart contract.
We really need a good way to visualize a smart contract. I know the classic textbook analogy is a vending machine, right?
Right. You put in a coin, you press a button, and the physical mechanism automatically releases a soda without a human cashier needing to be there.
But I'd actually push that analogy further based on the text. I like to think of a smart contract as an escrow agent made of pure math.
I really like that.
Hmm.
Walk us through how that math escrow works in a real-world scenario.
Okay, let's look at international business. Imagine a freelance software developer living in Nigeria who is hired to build a custom application for a tech company located in Germany.
A very common scenario today.
Right. In the old system, the developer finishes the work, sends an invoice as a PDS, and basically just prays the company pays it.
Because enforcing a contract across those borders is a nightmare.
Exactly. So the German company initiates a wire transfer, which goes through correspondent banks, takes 5 business days, loses a chunk to foreign exchange fees, and finally arrives. It requires immense trust and huge administrative overhead.
Now apply the smart contract.
Right. With programmable value, the developer and the company create a digital contract on a blockchain. The German company deposits the internet-native payment directly into the smart contract, the math escrow.
So the funds are locked.
The funds are locked. The developer in Nigeria can look at the blockchain and see that the funds are guaranteed.
They know the money is actually there.
Yes. And the contract is programmed with a very simple if-then logic. If the developer submits the finalized code and it passes automated testing, then release the funds to the developer's wallet immediately.
The second the condition is met, the money moves automatically.
Instantly.
Nobody has to approve an invoice.
Mhm.
No compliance officer has to review the wire. The money executes line by line, just like computer code.
It completely removes the need for humans to manually reconcile trust at every step of a complex transaction.
This is a massive paradigm shift. But as we absorb all of this, our source material heavily emphasizes a concept called the layered view. And this is crucial for grounding our expectations.
Yeah, we have to talk about the layered view.
The text makes it explicitly clear. This new layer of crypto and programmable money is not here to completely destroy and replace all cash and all traditional banks.
We are not heading towards some dystopian sci-fi future where paper money is outlawed and Wall Street is dismantled overnight.
No. The history of money is additive, not purely substitutive. When digital credit cards arrived, physical cash didn't just vanish.
Right.
When mobile apps like Venmo were invented, traditional checking accounts didn't disappear. New layers of money emerged to solve specific new frictions, and they end up coexisting with the old layers for a very long time.
Exactly. I mean, just think about your own wallet right now. You might use physical cash to buy a hot dog at a street cart because it's private, it's easy, and the guy doesn't take cards. But you use a traditional credit card to buy a flight because you really want the fraud protection and you want the airline miles.
And you use a mobile app to split a pizza with friends.
They all exist in a stack. Crypto simply becomes one more layer in that stack. It might be the layer specifically used for global creator economies, or for managing digital ownership, or for instant cross-border corporate settlements.
It doesn't have to replace the dollar in your pocket to be profoundly impactful to the global economy.
The layered view is such a great antidote to the extreme binary thinking that traps so many people online.
It really is.
You don't have to believe crypto will conquer the world and become the only currency, nor do you have to just dismiss it entirely as a useless fad. It is simply an expansion of form, a new tool for specific jobs that traditional banking just struggles to handle.
Now, understanding the underlying technology is intellectually stimulating, but I want to ground this completely in the real world. Our source material calls out several lingering myths that hold people back from seeing this clearly.
Let's do a rapid fire on those myths. Because a lot of people listening, and plenty of critics mentioned in our sources, view this entire space exclusively as a casino.
Oh, absolutely.
They see the volatile prices of tokens, they see the headlines about day traders making millions or losing everything, and they just assume the entire tech layer is wild speculation and gambling.
And look, the speculation is absolutely real, it is deafeningly loud, and it dominates the mainstream headlines. That is an undeniable fact of any new, loosely regulated financial market. However, dismissing the entire technology because of the speculation is like dismissing the invention of the internet in 1999 just because people were gambling on overvalued dot-com stocks.
Oh, that's a great comparison.
The dot-com bubble spectacularly burst, but the underlying protocol of the internet, TCP/IP, went on to reshape humanity anyway.
Right. Beneath the noise of the casino, core engineering problems are being solved. Let's look at the practical implications. Take global remittances, for
A
example.
huge friction point.
Right now, millions of families rely on workers sending money back home across borders. And according to recent global data from the text, the average cost of sending a remittance is incredibly high.
We're talking sometimes taking 6 or 7% of the total transfer.
Plus, horrible exchange rates. So if a worker in Dubai is sending money back to their family in the Philippines, losing a significant percentage of their hard-earned money to intermediary fees and making their family wait days for settlement is a massive human friction.
An internet native value can make that transfer instant and virtually free, directly peer-to-peer. It bypasses the correspondent banking choke point entirely.
Which is huge.
When you lower the friction of capital movement to near zero, you leave more wealth in the hands of the individuals who actually earned it. That is life-changing on a granular family level.
Let's look at another major shift, the creator economy. Right now, if you are a digital artist, a musician, or a writer, you are completely beholden to centralized platforms.
Spotify, YouTube, gallery.
Exactly. Whether it's a streaming service or an art marketplace, the platform takes a massive cut of your revenue, and they control the relationship with your audience.
Programmable value allows creators to encode their business model directly into the asset itself. Think about a digital artist issuing a piece of art as a unique cryptographic token on a blockchain.
Like an NFT.
Right. They can program a royalty clause directly into the smart contract.
So every time that piece of digital art is resold in the secondary market, maybe 5 years or 10 years down the line, the original creator automatically gets a 10% cut deposited straight into their wallet.
Executed by the math escrow.
Without any gallery or platform acting as a middleman to enforce it, it literally rewrites the economics of creativity.
It does. But perhaps the most crucial point for the listener to internalize today is the concept of silent infrastructure.
Silent infrastructure.
Because you might be listening to this thinking, well, this all sounds fascinating, but I have absolutely no desire to ever manage a cryptographic wallet or secure a private key or buy a specific token.
I don't want to be an IT manager for my money.
Exactly. And the reality is you probably won't have to.
That actually reminds me of how we use the internet today. I have absolutely no idea how the SMTC protocol routes an email. I don't know how TCP/IP packet switching works.
Nobody does.
I just type an email address, hit send, and expect it to arrive.
Exactly. The future of this technology is silent integration. In the near future, you might use a sleek, beautifully designed application on your phone to send money globally, or buy a digital asset, or invest in a piece of fractional real estate.
And it will just feel normal.
It will. The underlying rails powering that transaction will be cryptographic, internet native, and settled on a blockchain. But the interface will just look like a normal financial app.
The complexity will be totally abstracted away by the companies building on top of the layer.
You won't even know you're using crypto. You will simply experience a new normal of incredible convenience, speed, and ownership.
The infrastructure will just disappear into the background, just like the banking ledgers did, and just like physical vaults did before them.
Exactly.
Which brings us to the culmination of this massive journey. We have covered an astonishing amount of ground today.
We really have.
We trace the continuous line of human ingenuity, starting from the frustrating days of bartering grain.
Looking for a match on the dating app.
Right. To the revolutionary invention of holding standardized physical coins to decouple time and trade. We explored the massive leap of trusting institutions like the Medici to hold promises on paper ledgers.
And then moving to screens.
We walked through the surface-level magic of swiping screens and the rapid social adoption of QR codes in places like India. And finally, we dismantled the correspondent banking system to show exactly why we need the frontier of programming digital, internet-native value to act like software.
It is such a profound trajectory when you view it from end to end. It is really the story of humanity relentlessly seeking better ways to trust one another, to coordinate our efforts, and to scale our potential.
Money is not a static object.
No, it is a living, breathing operating system for human coordination.
And as we wrap up, I want to leave you with a brand new, highly provocative thought to chew on. Something drawn from a very brief, almost throwaway mention toward the end of our source text regarding the future of machine-to-machine transactions.
Oh, this is the really wild stuff.
It is.
Yeah.
We have established today that the entire history of money, from shells to smart contracts, has been about human beings finding better ways to trust and coordinate with each other.
Right.
But What happens to our global economy when money becomes a tool for machines?
That is the true frontier beyond the frontier.
Yeah.
Because if money is just programmable software, it doesn't actually need a human to push the button.
Think about the implications of that. When value is truly programmable and internet native, what happens when your autonomous smart car has its own digital wallet?
Right, you're just asleep in the backseat.
You are asleep in the backseat, and the car autonomously negotiates and pays a toll road, or outbids another car for a premium spot at a charging station, settling the transaction instantly in crypto.
It's incredible to think about.
What happens when AI agents can independently rent server space, hire other AI agents to solve specialized coding problems, negotiate the contract, and pay each other instantly, without a single human being involved in the loop anywhere?
If money is no longer exclusively a human tool, the scale and velocity of the economy we are about to witness is completely unprecedented.
It forces us to ask profound questions. What kinds of economic relationships and what scale of global efficiency can be built natively into networks when the primary actors transacting aren't even people?
It's mind-bending to consider.
But that is exactly what we are going to explore next time. In our upcoming follow-up deep dive, we are going to move entirely past the history lesson. We are taking the technical foundation we built today and driving straight into the future impact of programmable value on the structure of global business and the rapidly emerging machine-to-machine economy.
You are not going to want to miss it.
Definitely not. So if this deep dive helped clarify the noise for you, if it helped you see this technology not as an alien invasion or a pure casino, but as the next logical chapter in the long story of human engineering, please share it.
Send it to someone who needs to hear it.
Send it to that one friend or colleague who still thinks crypto appeared out of nowhere just for tech bros to gamble with. Help them see the bigger picture. We are at a transition point in history, and understanding the context is the only way to navigate it intelligently.
Absolutely.
Think back to the very beginning of our conversation. Money feels like an invisible law of physics, like gravity. But now you know the truth. It's a technology, it's a social contract, and right now, the underlying code is being rewritten. Keep learning with curiosity, and we'll see you in the next deep dive.